Hey everyone, Shalonda Armstrong here. Today, we have an amazing episode as always, but something a little special. The conversation was so good, we decided to make it a two-parter. So this week, you'll get part one, and we'll release part two next week. A lot of gems are being dropped, so I hope you learned something and enjoy the show.
Hi, everyone. Welcome to the Check Writers Room. 3 GPs, 3 angles, 1 hot take.
I'm Yasmin Cruz-Farine.
I'm Shalonda Armstrong.
My name is Sydney Thomas. Let's get into it.
We are joined by a special guest today. Jessica Loché-Eggert from Madison West will be joining us in conversation as we talk about the thing that is the most important in venture, the exit. So we are excited to get started. But I have a feeling that there's a hot take brewing. And Sydney, what's the hot take this week? I feel like you have something. Just your face lets me know that there's something brewing there. So what's your hot take for the week?
Okay, so my hot take this week is that I did, shout out to my newsletter. I did write this in the newsletter last week where we talked about how the next great seed fund will not be in the Valley. The Valley style VC has essentially they've gotten distracted. They've become a bit grifter-esque. They got really, really blinded by the dollar signs that are coming out of some of these Anthropic deals, OpenAI deals, and I also think they're getting a lot of pressure from their Silicon Valley-based LPs to be in those deals, but those are not how you generally do venture seed investing. Investing in a seed round of Anthropic, that's like already what Yasmin's check from Spark was 75 million into the seed round. So that is not how seed generally works. Generally, seed requires you to be very ownership sensitive, very thoughtful about what the valuation is on entry point so that when you get that awesome exit, like we're going to talk about today, you have some space to grow. The company has space to grow and you have space to grow from an investor perspective, and something that can make you, your LPs, and your founders really excited. So my hot take is that the next great seed fund is going to be out of one of the ecosystems that we operate in, San Diego, Washington, D.C., Charlotte/Boston. It's not Silicon Valley's, they're kind of telling on themselves right now.
I think we are seeing a lot of, and Yasmin, I would love to get your thoughts on this, a lot of those, what we would call pre-seed investors in the Valley, start to drift away, right? Jason Calacanis has come out and said that he doesn't want to do pre-seed anymore, and he's moving up the capital stack. We're seeing other firms do the same. And I do think there is a reason, right? LPs want liquidity, and they want liquidity fast. And now everyone is trying to figure out what's the quickest way to raise capital. And so, yeah, you want to go after the big deals and the proven names. I also think that there's this big gap between Series A and Series B. So is now all of the pre-seed investors are going to become Series B investors now? I'm just a little confused on where everyone's going to land, but I agree with your point, Sydney. I do think those who traditionally love seed for what it truly is and not writing crazy checks at crazy valuations, I do think that that's going to migrate to other ecosystems now and may not live in the Valley anymore. But Yasmin, we'd love your thoughts.
I think this is a case of folks seeking DPI, right? And what I'm trying to understand and parse out in this moment is how many fund managers are changing their 80% bucket to be more opportunistic, or how many folks are really just talking about what they want to do 20% of the time. Because there is a case for, if you can get access to a deal that is more of a moonshot and maybe not central to your thesis, then many of the defining top tier VC firms, you would be surprised as to what created DPI in their Fund 1 and Fund 2, and it often wasn't what they told LPs they were going to do. And here they are 10, 20, 30 years later because they were early stage and they did a Series E, right? That was pre-IPO. And that is what created their ability to stay in the game. So I think what I'm trying to, and we're going to get into this, so I'm not trying to segue us too early, is with AI, the valuations are insane. And so the swim lanes are starting to blur. What is clear for me is, yeah, I mean, our median valuation when we came into the market with our fund, we had a very finite expectation, and maybe in how the market's been moving, we've kind of done a few more deals that are on the upper limits, and over the course of the portfolio, I think, hopefully we'll get to where we want to be when we launch Fund 2. But I think with the valuations being where they are, with the expectations LPs have around DPI and the level of like MOIC, the multiple that they're looking for, I think folks are really nervous that the traditional model isn't going to get them into the outliers that's driving the conversation right now. And I think, to say it more plainly, I saw that Micah from Founder Collective looked at the last 25 years of venture, and the median return across all sectors was $2.7 billion, right? So a median exit is $2.7 billion. So what we're talking about in the top 5 companies, the gap between the kind of those extreme valuations and a $2.7 billion exit, there's like a whole large, I mean, you could put the Grand Canyon between those two extremes. And I think that's why fund managers, like, it's kind of confusing. Like, are you gonna still underwrite when a lot of that information isn't available to you as a pre-seed investor, or are you gonna go and back some founders where you have a sense directionally what the exit potential might be?
That's a great point, Yasmin. It might be 20%, but I think, is it 20% in number of deals, or is it 20% in actual capital deployed of the fund? Like, I think I would be really curious, because if you're only doing one deal, but it's into Anthropic, and your fund size is 20 million, just to get into that round, you're probably putting $1, $2, maybe $3, $4, $5 million into that round, which at that point is less of a 80-20 and actually much more of a real strategy shift. And then when you have this significant strategy shift, you're then opening yourself to a different competitive set. And will you win against that competitive set? Will you win against Sequoia? Will you win against General Catalyst? Will you win against Spark? Probably not.
Great point.
Right? Just real talk. Probably not. So
Well,
are you setting yourself up to fail?
Yeah, and I think you raised a good point, and I think others have said this. Like, if you've spent a decade building a machine around sourcing a particular type of founder, underwriting them, then growth and Series B and above looks easier. Like, maybe once it's a trend, you're too late, right? And so I think some of what's being talked about underestimates some of these realities that you're talking about, Sydney.
And I want to bring Jessica into the conversation, because Yasmin, you hit on a good point, is that a lot of the early firms, the legacy firms that we know today, they were managing for an exit because they needed DPI to survive. And Jessica, I know that you have the experience on managing to exit and what that looks like. So I would love to get your thoughts on this. When you're seeing early stage start to move up the capital stack, kind of what is your immediate reaction to that?
I mean, what you guys are talking about is so interesting here, because what we're really discussing is kind of two things. It's a K-shaped economy that we're dealing with right now, and then the ability to take more shots on goal. And so when I think about in the K-shaped economy, right, like we've got very different things being reported. We've got the folks who are, okay, $2.6 billion median exit. That's wild, right? That's a whole different level. Then we also have 1,400 global private unicorns sitting here. Where are they going, right? The market can only handle and take on so many IPOs, right? And so, we've got these groups here with like these zombie rounds, like no, the median part of the industry and like in startup world, right, is like the part that nobody really covers or talks about. And I think it's where, and not think, it is where like the actual volume of the K, right, is actually sitting, right? And it's these groups that are doing $10 to $50 million in revenue, creating enterprise value from like 40, 100 to 150 million, right? And that's a great exit. And I think a lot of these, yes, you can't fight against the Sequoias, but the Sequoias they're taking shots on everything, right? They get the ability to take shots on the really big, crazy things, and they look like geniuses because one out of, the 300 investments that they made ended up looking good. Ooh, they look good there, but what about all the rest of them, right? And I think that what's super interesting, Sydney, kind of coming back to your hot take that more of these pre-seed and seed VC funds are going to be outside the norm. I think it's because they know that they can't fight against the Sequoias. Like, why would you? Why do we want to, right? They're not VC funds at this point, right? They're a whole asset class over here, right? And they are the Wall Street of Silicon Valley. It's very real. Like, they're just sitting in a different realm. And so we don't compete against them, right? As founders, we also know, like, we don't look at our competitors. We don't compete against them. We focus on where we are. And where we are is we can take shots on goal with this middle of the ground, right? Right? These companies that are going to do 10 to 50 million in revenue. And we're going to start paying more attention to them, right? We're going to start thinking about, when I was as a founder, I would hear from VCs, even as of recent, right? Hey, we have 5 winners, and everybody else is just kind of like the losers of the portfolio, right? We can't help them, right? And they're not being rude, but they're just like, there are a few ones that we can help because they're the ones that are going to return the fund. Well, we have other funds that, Sydney, like yours, that are like, well, actually, we believe we can get the majority of our companies to an exit. That's a different type of VC fund than a Sequoia. And so, coming back to your question, Shalana, on like these companies as they take on more funding, I start to, and I talk to them all the time. I'm like, the world that they're trying to play in is a very different world from their reality. Their reality is you're not going to be $1 billion business. That's okay, right? I honestly, to me, and I knew it, right? As a founder, I could get to the company to a certain point, and I was like, oh, this isn't going to be $1 billion business. Well, then why am I going to keep playing the $1 billion business game? Why am I going to try to raise on a valuation that I can never grow into, right? That is just going to make me lose, going to make my investors lose, right? And then I'm going to be so disillusioned and so disappointed, I'm not going to want to do it again. Well, that sucks. That's not, we're founders, we're entrepreneurs, we're going to do it over and over again. But then we set ourselves up for failure when we sit there, we look at those $2.6 billion median, exits and say, oh, I can become that, when you know that your company actually can't. So, that's as we start to talk to, and we can like dive in a little bit more in the background, but, these companies that start to take on more and more funding, I ask them, what does that exit look like for you? What is that valuation? Can you actually grow into that? Or are you setting yourself up for failure? Because a company that takes on, $150 million valuation and can only exit for $50 million and they get no money back, that's not an exit. That's not a company anybody wants to acquire. The founder's not excited. They're not incentivized to keep going. that's a company that's going to end up dying out.
I love your point of view on that, Jessica. And so I want to transition into what does it look like to build with the exit in mind, right? As founders, I think of course, there's a lot of excitement at that pre-seed seed stage. And
Yeah.
a lot of founders, they quote unquote want the IPO because it seems sexy until they actually get real revenue and they realize all of the regulations and headaches that comes with being public. And so how do you start to build your company from the early days, building towards
Yeah.
that exit?
Yeah, I think it's so interesting because I never want a founder to walk in being like, I can't be $1 billion business. Because I think you should shoot for the moon up front. Like, we should be a little crazy and say, we're going to win. Like, I'm going to be around for forever. I'm going to be a billionaire. Um, and so I think the conversation at a pre-seed seed stage level is different from the conversation you're having with yourself at a Series A. At pre-seed, seed, I don't want anybody, any company, any founder I talk to be thinking about what that acquisition looks like 3 to 4 years from now. Because as a founder, like once you get to that mindset, you kind of slow down, right? And I saw it. Once you start having those acquisition conversations, if you're tied between let me go raise money or let me have the acquisition conversations, this is a different mindset. Those two are completely different mindsets, and it's very difficult to go in between the two of them while you're also thinking about building your company, right? And so at a pre-seed seed level, shoot for the moon. Like, go talk to as many customers as possible. And and I would defer to you all, but the bar keeps moving. And so at the pre-seed seed stage, the growth that you have to have, the traction you have to have is very different from what it looked like when I was building COVID era and pre-COVID era.
Can we talk
This,
about that for a minute? Because
uh,
that's such a great point, and I think it actually ties very well into the strategy, the fund strategy conversation, because there's something about that where it used to be much more clear cut. That's like you raise your first round that then gets you to a seed. Maybe or maybe jump across seed and get to Series A, and from Series A to Series B. But it does feel like because these rounds are becoming so much more um, convoluted, that actually it's almost like you do need to start building with an exit in mind more quickly, or else you can get really, I think, actually more distracted by the VCs who have these very differing expectations around what you will need to actually achieve that next round. Like, I feel like a year or two ago, it was like, once you get to 1 million in ARR, you can start talking about, seed. And then, 6 months ago, it was like, once you get to 5 million in ARR, you can start talking about seed. It's just completely chaotic at this point, in a way where I think like you do need to have a bit more of a grounded perspective around like how are you building, like where are you building towards, and how are you getting there in a cash efficient way that might require you to think through exits more like earlier on in your company's development than might have been true, I'd say, even like a year or two ago.
Well, Jessica, your background is in healthcare. I mean, you've built in healthcare for decades, so you can speak to that specific lane, because I've seen a few decks recently in healthcare, digital healthcare companies that have mapped out, and I'm a pre-seed investor. We think, let's say they're in autoimmune, right? And then like, okay, these are the potential big pharma companies that have a pipeline in this space. And this is what a logical exit would mean for us in this space. This would be if we kind of remain quote unquote more independent, then this could be kind of more like an IPO type reality, and they have kind of the $500 million exit, the $100 million exit from a strategic M&A perspective. There's the PE universe, which you have a lot of insight into that we should talk about, because they're rolling up in digital health as well, bringing AI into the space. What would that buyer, what would their price point be? And then what would the IPO? And honestly, multi-exited founders are stepping to me this way. It's the kind of first time founder that is kind of like, you know, you want me to dream big. I need to have a Sam that's like with a lot of bees, and like we're going to the moon together. And I appreciate that, and I agree with you, Jessica, but honestly, I think if we're talking, you know, 2.7 billion is the median, then like, and you've built multiple companies, then you actually already have relationships with some of these strategics. So it's not an intellectual exercise, and you can speak to it. You can speak to your last exit, right? And what happened there. And you're bringing that information to bear in the conversation at day zero. And I actually think that specifically in digital health, I really appreciate that.
Yeah, I think in digital health, healthcare technology, everything is shifting so quickly. And I do agree that second time founder, you have the ones who are like, listen, I'm just going to bootstrap this. I'm going to do this on my own. I'm not going down and playing that game again. And then you have the ones who are like, yeah, we actually can be something really big, but we're not going to go raise on a $75 million valuation with $2 million in revenue. Sorry, right? Like, we know that plan A is, hey, United, Optum, that, you know, and they're not really doing any acquisitions right now, but we believe 3 to 4 years from now they are going to be, and this is why, right? They're coming with realistic thesis around where their industry is going and what the potential is for them. We see that quite often, right? But then one of the things that shifted significantly, though, is number one, a lot of companies are getting acquired on EBITDA in tech world, right? Like, to us, that is foreign. That's a foreign world. And they think profitability is it? It's like, no, it's not just profitability. It goes beyond that, right? Yes, and we want to hit profitability. That would be wonderful. Everyone's talking about that these days. But I think that, you know, because so many people are getting acquired on EBITDA, a lot of these founders are thinking about, hey, what's the worst case scenario for my exit, right? These second time founders know that they can get their company acquired. 100%, you're right, Yasmin, is they have relationships, and it's a relationship driven world. You will find the PE group, the strategic, the family office, right? That's actually happening a lot more than often. That is going to acquire you. You're going to have had those conversations. They're going to say, hey, we want to see this at a minimum, and you know what to shoot for. And so, you know, I think those second time founders are super interesting. The early founders, they are still saying, and we're seeing them get funded. They're still saying, hey, I'm gonna IPO. I'm gonna get acquired by one of the top 4 payers. No, you're not. Sorry. It's just so unlikely. It's so unlikely. But again, at that pre-seed level, I mean, like, you kind of want them thinking that crazy, because those are the ones who are kind of ballsy, right? And they go out there and they will go cold email every single CEO, right? They're going to get in someone's like inbox. They're going to get read. They're going to have potential. Like, they may come in from a cold start, right? Not have any of those relationships to sell into. I want them thinking crazy like that at that level. But when it comes to Series A, I don't want them thinking, hey, I just hit $5-6 million in revenue and I'm going to go have an $80 million valuation. I asked a founder the other day. I said, he came to me and he's like, yeah, we just hit $75 million valuation. I was like, cool. How do you grow into that? And he goes, well, I guess that's a question for you. I'm like, ooh. Yes, and this is also something I want you to think about before you raised, right? Not afterwards. It's an exercise that you have to think about walking in. It's an interesting world.
Then I would love to touch on the PE part, right? Because as we're seeing more companies start to explore the PE route. I think that there is some sobering that happens with founders because the multiples are not the same. And I know that technically venture is part of the PE asset class, but we're very different. And
Yeah.
the way that we underwrite is very different. So I would love to get your perspective of what you've been seeing because I don't think founders are ready for that 2 to 3x markup on revenue when it comes to PE.
100%. Yeah, so we, at Madison West, we've tracked over 580 exits in the past 2 years. That's not including the 4 that just got announced this week, right? It's happening very, very quickly. And over those 580 exits in healthcare technology specifically, not brick and mortar, that's a whole different world. But of those health tech exits, 45% of them were going to PE. Now, what people need to think about is only a quarter of that is what a fund is actually buying directly. The rest of them are companies that PE already owns, right? So those are the ones that are acquiring, and that's kind of the machine that founders don't see and aren't paying attention to because they see these companies as that's an old school company. Well, that old school company actually has way more distribution than you'll ever be able to touch, right? They're not going to be buying you for your distribution. It's a different story. They're going to probably buy you for the technology, for the data to help them go faster, help them go deeper in with their customers, because those are the sleepy giants that are actually winning, especially in healthcare technology. And so these PE groups, right, the exits around those are not pretty. I've got a company that's doing really, really, really well. I can't say their name out loud, but they haven't been around. They've been around for not even 18 months. They're doing insane in revenue. They're getting valued on EBITDA because they're looking at an acquisition from a PE-owned sleepy giant that's doing just an insane amount. They're doing over $100 million in revenue. It's one that you just don't think about. I would never have heard of before, but they're getting valued. Now, because of how quickly this company is growing, we're seeing closer to that 8 to 15x EBITDA multiple, right? You can talk about your growth. You can talk about your excitement. You can look at, they just don't talk about forward revenue multiples. They're yeah, that's nice. That's cute. Here's what the facts are right now. Here's what you look like today, right? Now, those companies are interesting. Now, if they were looking at forward rev multiples, 2-3x highest, right? That's what we're seeing, especially if you're a feature. Now, I think that there's the platform level, right? So that's the PE world specifically, where 45% of health tech exits are going, right? But you sit outside that and you've got corporations that are starting to heat up. You've got family offices and sovereign wealth funds that are popping in, wanting to build out platforms. But yeah, I think you have to be realistic that a large chunk of the acquisitions are going to these PE-backed groups that are not pretty and aren't valuing you and actually tend to not like to touch VC-backed companies because of how upside down they are.
Hey everyone, that's a wrap on part 1 of the conversation, and we look forward to sharing part 2 with you next week.
And that's the Check Writers Room. Special thanks to Natalia Skoko for editing. Subscribe to our newsletter and view show notes at checkwritersroom.com. Leave us a review wherever you are listening.